What is going on, my fellow Summit Chasers, and welcome to another episode of the Summit Chasers podcast. I have a very special guest today. It's a little bit different than the typical guest we would have on the show, Mr. Brian Head. Now, he is the founder of Head Start Equity. That's a real estate private equity firm that provides passive investment opportunities in primarily value-add multifamily properties. Now, as business owners, you start to get a little bit successful, get a little money in your pocket. You want to invest your money. That's the smart thing to do. And obviously, a very popular place to invest your money is in real estate. So Brian really does a great job of highlighting, as a busy business owner, how do you get into investing in real estate to begin with? Where should you prioritize your time? Things you should avoid and things you should focus on in the beginning. So this is a great episode. We go into a lot of other things, as overcoming imposter syndrome being one of them, how to look for mentors when you are looking to get into real estate and investing in general. So this is great. So sit back, get your notebooks out. Maybe for this one, grab a couple stacks of pancakes, some syrup, and a coffee, and enjoy the show. Beautiful. Well, I'm very happy to have Brian Head, now that I know confidently that it's Head, not Heed. Brian Head, founder of Head Start Equity.
Yeah.
Is that what it is? Beautiful.
It is.
So why don't you, let's start off really simple. A subject that you know all about. Let's talk a little bit about you and where you come from and how you got to where you are.
Sure. Yeah. So I remember I used to listen to one podcast, and the host would always say, "So just tell me a little bit about yourself. You were born, and then what?" I was like, "Okay, well, I'm not going to go back that far, but
yeah."
So born and raised here in San Antonio, Texas. Lived here all my life. Married. With two daughters, of a 5-year-old daughter and a 12-year-old daughter. And I actually left a corporate job that I was at for nearly 25 years back in May of 2022 to focus on Head Start Equity to start my business and do it full time. But in that job, I was in the financial services industry, and for about half my career, I was a stockbroker. So I had my securities licenses and financial advisor, and so I was doing some of that stuff, and that was a lot of fun. But I had always been investing in real estate on the side, so I've been doing that for over 20 years. And my story is similar to a lot of real estate investors in that, I started out flipping and single family, and then single family rentals, and then got into some Airbnb. And then kind of ramped up to smaller multifamily, purchased a duplex and then a triplex, and was kind of humming along with that. And then, we had a life event take place where my wife was diagnosed with breast cancer back in 2018. And fortunately, she's cancer free now. She's doing great. But it really made us kind of reflect on life and the direction we're going and what we want to do. And so that was kind of the impetus for getting into the larger 100 plus unit multifamily complexes that I'm purchasing now. And so that was kind of what geared us toward that, because we realized we'd be able to kind of ramp up faster and scale faster if we went a little bit bigger. And so that's been a big learning curve over the last few years, but a lot of fun. And of course, it's had its challenges, especially with the interest rates going up so much and that whole economic environment. But it's been fun.
That's amazing. So what initially, there's two things I want to hit on right there.
Yeah.
What was it like when what was that moment, that 30 seconds of courage you needed to be like, I'm leaving corporate, I'm leaving my 401k, I'm leaving my medical insurance to doing your own thing?
Yeah. So, it was a couple of things. I would say one of them was not long before I made that move, I had hired a business coach, and that was really one of multiple game changers for me. Having a business coach really helps you kind of hone in on your business and what you need to do to try to succeed. And quite frankly, they help give you some confidence too. I think all of us at some point suffer from imposter syndrome, and I'm no different than anybody else that suffered from that. And it still comes up from time to time. It's normal. But he was able to kind of help guide me in that direction and give me some of the confidence that I was lacking. And so I think that was probably one of the biggest things. And then, as a side to that, it just coincided with the fact that I ended up, and this is what ends up happening for a lot of people when they're in the corporate world and they leave their job, you end up quitting your boss, not necessarily the company.
Mm-hmm.
And that was kind of where I was. And like I said, I was there for almost 25 years. And so it just got to that point where I had to make the move. I was so stressed out and physically, noticing changes and not feeling good. And so it got to that point. So there was quite a few different factors in there, but those were some of the big ones.
Yeah, I mean, that's a great point, too. Well, first of all, good for you for putting your ego aside and getting a coach, a consultant, a mentor right away. Because the point that
Yeah.
you hit on that I like, and I even identify that with a lot of like our clients, like they have the skills, they have the knowledge of like whether it's the industry knowledge or they know how to lead, they've managed before, they know what I's to dot, T's to cross sort of thing, but it's packaging it and then using it, like, and then being confident with it, being able to use that package once you do put it together. And then where do you kind of put those pieces that you have, and what pieces should you keep and what pieces should maybe you give to somebody else, or should you leave to the side for now? Because it can be daunting when you're starting a business. Either like you said, imposter syndrome, I don't feel like I can do anything, or I want to do everything. Right. And then if you want to do everything, you might as well do nothing. Right. Because it's very hard, obviously, to focus on that much, and then you get spread too thin, and everyone can kind of put those pieces together there. So good for you for making that decision.
Thank
I think
you.
a lot more people need to do it more proactively, like you did, as opposed to waiting until you're drowning. Right. Which, I mean, either way, I mean, some people will still won't put their hand up and ask for help when they're drowning. They'll just
Yeah.
try to swim. Right.
Yeah.
So that's awesome. The other point I wanted to hit on, well, first of all, quitting your boss. That was that what kind of pushed you over the edge, was quitting the boss, or did you have more of, I can do this, like I have a dream I want to accomplish on my own, or was it more like I'm going to quit this and do it right on my own?
I think it was probably half and half. I mean, like I said, I've been investing in real estate for over 20 years. So, from a confidence standpoint, I had some of that. And realistically, even if you're just managing one rental property, you're a business owner, you have your own business. And so I knew at that point, because I had scaled some at that point, that I could do it. But it's hard to leave the security of a corporate job, like you said. I mean, especially when I'd been there so long, and it's really, it's all I really knew was that company as my whole adulthood. So that was hard, but yeah, I mean, it was. I was also getting to a point where, because I had already started in my larger multifamily business while I was still in the corporate job, and it was getting to a point where it was getting hard to manage the two, having a full-time job plus trying to build my business, and realizing also that if I really want to scale and I really want to grow this thing, I have to be able to give it 100% of my focus, and I wasn't able to do that, obviously. And so that, I think it was a combination of both of those. And I, being in the corporate world, I learned a lot, and I think I got to a point with where I was that, I also just was not happy. I wasn't happy with my boss, but I also, I was always an entrepreneur, really, at heart, and kind of doing it on the side was, I guess, kind of my release and my outlet for that. But then I think it finally got to a point, again, with that life event that took place and everything. It was like, okay, like, just own up to who you are, and get out of that corporate job and move on. And that's what I decided to do. So
I like what you just said. Own up to who you are. Some people will hide behind that comfort, and then they'll never be truly. They'll never know. First of all, like, they could get to the end of their life and never know. Okay, could I have been successful at this? What kind of success could I have had? How happy could I have been? That would be that's a scary place. That's what really pushed me, was I don't want to get to the end of my life. I don't want to be 80, 90, 100 years old. God forbid that hopefully that happens, and be like, man, what if?
Yeah,
I probably
that
could
was
have.
that was actually one of the questions that I got from coworkers when I was leaving was, aren't you afraid to go and do this on your own? What if you don't make it? What if the business doesn't make it? And I actually told them what you just said. I said, well, I'm actually more afraid of, continuing on in the same path and never taking that chance and wondering what if, right? And so I was more afraid of that than I was the comfort of what I was leaving. And I'll also say too, I have an amazing wife who has a pretty awesome job too. So I have to admit that, that doesn't hurt when you have some of that. So there was still a little bit of security there. But it was still a big change for me.
Yeah. I mean, and that most of the time, that's how you should do it. We get these glorified stories of these entrepreneurs that I had nothing. I had to live in motels and I still made the leap. It's like, okay, you're like, but then how many behind you did that and didn't, are still living in the
Didn't make
motels,
it.
right?
Yeah.
Like, don't, like, that's not the only path for like abnormal success, right? So, and then when
Mhm.
people like they almost feel ashamed. I'm not saying you did, but there's some people that I'll have this conversation with. They almost feel ashamed, like, my wife had a good, or my husband had a great job, or I had a lot of money in the bank already, or I had a nest egg. It's like, okay, so you did it the right way. You did it how most people
Right.
should do it,
Right.
right? Like that's
Yeah.
okay. You don't need to be the hero.
Yeah. I kind of liken it to, and this is kind of veering off just a little bit, but, with what people's personal investments and what kind of things they invest in, and meaning, there, because there's theories, right, or proven theories, right, of how you should invest, right. You should have X% of your portfolio in stocks, X% in bonds, based on how old you are, for growth, for so you have enough money when you retire and all that stuff.
Mm-hmm.
But then at the same time, people have to be comfortable with that investment, and so
Mm-hmm.
if you're somebody that's going to be, buying high and selling low,
Mm-hmm.
then maybe you shouldn't be doing it. If you can't handle the roller coaster, then maybe you would be better off just investing in CDs, or you're not going to keep up with inflation, but you're also not going to be getting all emotional and selling it and buying at the worst time. And you could draw a parallel to that with, taking that leap. And
Mm-hmm.
so everybody has to do it at what's the right, whatever the right time is for them. And nobody should be judging, well, why did you take so long? Or, uh,
Mm-hmm.
you got to do it when it's the right time for you. I've had people ask me, well, do you regret not doing it sooner? And yeah, I mean, there's a part of me that's like, well, what if I'd have done it sooner? But maybe I needed to go through all of that experience of my
Mm-hmm.
life to get to that point,
Yeah.
to be comfortable, right, to take that leap. And so I think that's everybody's. There's no judgment there. Everybody's got to do it when it's right for them, if they do it at
Yeah.
all. We need people in the corporate world too, right, to make the world go round. So
Yeah, we're not advocating everybody just go quit their jobs and start
right,
doing their own thing.
exactly.
But because, I mean, some people, like you said, they're just not, that's just not their thing. Like they like
Hmm.
being, some people do really well being the number two, or just they like the routine. That's what makes them happy. They prefer to
Right.
focus on hobbies, right? And then their
Hmm.
corporate 401k, they get healthcare for their family. I mean, who like we're crazy.
Yeah.
Like they're the smart ones in a lot of ways, right?
Right. Right.
So
Exactly.
no, 100%. So there's a question that kind of came up in my mind, and I needed to give myself a minute to remember it, and I just remembered it. So with talking about timing, wanting to get into real estate investment, let's say you're a business owner, you've worked with, whether it's your coach or you worked with us, whatever it is, and you've got to the point now where you can kind of step away from your business a little bit and focus on passion projects. And one of those passion projects, you've always wanted to invest in real estate. You've never done it before. You don't know anything about it, other than you got to buy low and sell high, the typical whatever.
Mhm.
What would be your advice to them, knowing that this isn't going to be a full-time thing? They're still a business owner. They don't know anything. Where should they start to build a portfolio from? Again, from not knowing anything to having a fairly decent portfolio.
Yeah, and that. So you're. Well, I think what you're kind of talking about is somebody that maybe is looking to do it more passive. They have a full time thing that they want to do,
Mm-hmm.
and this is more. They know they should
They're
be in real estate.
exactly. They're running a business. They just want to invest the money, that their hard earned money, into something that's going to
Yeah,
increase their value.
yeah. I think that's where, and I know it's overused, but education, right? You want to. It's good to, obviously you have to find people that you want to invest with, that like, and trust, right. That's huge and important, and I would argue that you know the person you're investing with is more important than the deal you're investing in, because if they don't know what they're doing, and they're not up to par, then that great investment that they're getting handed may not work out, right. So
Mm-hmm.
that's probably more important. But what is the cliche I was talking about is education. It's just education is the most important thing, and there's plenty of ways to educate yourself. Find somebody that is doing it. Pick their brain. But podcasts are one of the ways that I learned. I still am a huge advocate for reading or audiobooks as well. Um, and, I would say start those conversations with different people that are offering those type of passive deals. And, don't just pick the first one necessarily that you talk to. Interview multiple ones, find out, ask them why they're doing what they're doing, what their due diligence criteria is, challenge their knowledge and their track record and things like that. And so, but I would say, those conversations, going to meetups is a good way too, to kind of learn a little bit more about, real estate in general. We have a local meetup here in San Antonio. But I think that's huge. There's a lot of education courses and stuff too. I think there are several out there specifically for passive people that just want to invest passively as well. Those can be good. But I would say, just start talking to people and just start educating yourself. I think you just have to kind of get out there, and you can't just trust but verify, right? You can't just assume that the people you talk to, they may sound smart and they may be a good salesperson, but that doesn't mean they know what they're doing and they have the right instincts. So I think don't jump into it. Don't jump too quickly. I think that there's a lot of people in my industry that just all they want to talk about is all the great things about real estate. Don't hesitate to ask about what's the worst case scenario, what could happen, what are the bad possible outcomes, and you need to understand that too. And so that would be my advice is, just try to go out there and learn as much as you can about it, and maybe use some of those channels I mentioned to learn. And if somebody's specifically that's listening and looking to get into multifamily, I can definitely help, any way that I can in terms of helping educate them specifically into that space.
So that's what I was about to say. Reach out to Brian. So what I'm hearing is, it's this very similar approach probably that they would take to their own business, right? It's looking at it as you're not just buying something low, selling it high. Like there's a lot of other intricacies that go in there, especially if you want to buy a house, you want to fix it up and flip it. Contractors, right? You got people you're building another team at that point, right? Mm-hmm. So when you say educate yourself, which amazing advice, don't jump into it. Don't just buy a house and then figure it out trial and error. There's other people that have done that. Where's like a good, like in what avenue, where should they start? So like, because I'm sure if you Google, real estate courses, there's tons of them. What's some advice as far as like where to veer them? Is there some that you've had great experience with? And if so, what makes them better than some others that you've seen?
Yeah. So, I would say it kind of depends on the route you want to go. But I know that, like, especially from a single family real estate investing standpoint, I want to say the book was The Millionaire Real Estate Investor. It's like a blue and white book. That was one of the best books that I ever read in the real estate space. It's super detailed and gives you a lot of information about investing in single family properties. The Rich Dad Poor Dad is a good one too. Robert Kiyosaki. I think probably most people these days now that are even considering real estate have probably picked that up and read it. I actually read it to my daughter when she was 11, putting her to bed at night. Oh, wow. It was kind of dual purpose, right? To help educate her, but it also kind of put her to bed kind of quickly. So, kind of helped there. But she now knows the difference between assets and liabilities. So that in itself is a win for somebody that's not even a teenager yet, I think. So
that should be taught. Speaking of a subject that should be in school instead of something else that's in there right now, like that's crazy. Sorry, I didn't mean to cut you off, Brian.
No, I agree with you 110% on that. I think that's, I remember my economics class, we talked about, stocks, and I'm going to date myself a little bit here, but, we were tracking individual stocks in the newspaper and stuff like that. And that's, kind of how we were learning about that stuff. And that's actually one of the things one of my first experiences that got me really interested in investing in general was that specific class. But there's not, at least when I was in school, which was a while ago, but there weren't any, classes about real estate in high school. Nobody really talked about that much. And it's a great way to build wealth. Specifically from my perspective, that's where I built 3/4 of my net worth is in real estate. So it can definitely be done. And, but yeah, those are some of the books. There's there's so many multifamily podcasts out there. If you're looking to get into multifamily, I'm actually planning to start my own podcast here probably in the next few weeks as well. So I'm looking forward to that. But that's going to be talking about different types of investments, and not just real estate, but different ways to build wealth. And so I'm looking forward to launching that. But yeah, I mean, I don't really have any specific courses I would say to go to. Those things change frequently, and honestly, there's quite a few out there that I'm not a big fan of. But I think, because there's so much you can learn for free now. Like you said, you can Google stuff and find stuff, but find some good books out there that have some good ratings. And if you read, ferociously, you'll become an expert. And so that's what I would say is just start there, and then just start trying to meet some people.
Yeah. No, that's good advice too. And the one thing that you said in there was figure out what you want to do first, because I mean, it could be multifamily, it could be just housing. I mean, there's other options. There's a lot Airbnb, right? There's lots of that. Just figuring out kind of what lane you want to go first, so that you're not educating yourself on a ton of stuff. Figure out what you want to do, and then, I mean, probably part of figuring out what to do would be to talk to somebody like yourself, so that, okay, how much time do I have? Where does my current skills lie? Because I'm sure there's various skills or varying skills that you need to be successful in one to the other, a little bit different. I don't know much, but I'm assuming, judging by your head nod. But yeah, figuring out what you want to do first, and then you can be more pointed in your education. So at least when you're Googling, you're not, how do I get into investing in real estate? It's how do I get investing into real estate type of thing, right?
Yeah.
And there's go ahead.
No, I'm sorry. I was just going to say, the only other thing I would add too is, and financial advisors are great. Just be aware that, financial advisors, generally speaking, not all of them, but generally speaking, right, they're going to be obviously compensated based on the assets you have with them. And they may not want to steer you toward these private placement type real estate investment deals and stuff like that, because they're not going to be compensated. The assets are going to be leaving their account with them and going somewhere else. And so I think that financial advisors are great for, the mainstream public type securities and public markets. When you get into some of these private placement deals, you're probably going to have to, for the most part, do a lot of self-education and from that perspective, and try talking to the right people. Just as a side note, because I've had I was one myself, but I've also had investors, and they're like, well, let me go talk to my financial advisor before I do this. And I'm like, okay, great. Yeah, go do that for sure. And they never ended up investing because their financial advisor talked them out of it. And again, they're not all that way. And I'm not saying, their financial advisor may also have some insight that I don't have. That's like, okay, yeah, this probably isn't the right kind of fit for them. So I'm definitely not trying to bash financial advisors, but I'll just say they may not be an expert in this particular field. So you kind of have to look outside some of those normal lanes you might go into to learn about these different types of investments.
They're more likely, anyways, like you said, they're not all bad. They might have an expertise, but they'll be more surface level. They won't completely understand. Got it. Okay, that makes a lot of sense. There was a concept. I had a guy on the podcast recently. His name was Dan Sanchez. He goes by Dan Chez. And he had this concept of ultra learning. Really, really interesting. However, if you have the time, I would look it up if you want to be a master in something like a specific field. Like, again, if you're the business owner who has a ton of time now, or has at least more time now, and want to get into investing in real estate, this is a good avenue to go, because it forces you to learn something really, really quickly. But he has this concept of the 30-30-30 rule, which was read 30 books, which is a lot. If you're a quick reader, that's easier. Listen to it on Audible, skim through them. And a lot of times, because I do the similar thing now, is I'll read 2 or 3 on the subject, and then the subsequent books after that, it's kind of like you start to see a lot of similarities, and now you start to be skimming through, this is a new concept, it's a little bit quicker. But read 30 books, write 30 blogs, but like short form, like posts, basically like short form posts to try to teach it. So now you're learning how to teach it, and then speak to 30 experts in the field. So it's read 30 books, teach it, or maybe it's the other way around. Maybe it's read 30 books, talk to 30 experts, interview 30 experts, and then do 30 like try to educate on 30 different types of concepts in it. And then in doing so, in the teaching part of it, that's when you start to conceptualize it a lot more. You start to internalize it and put it in your own words, your way of observing and that kind of thing, your own way that you can implement it. So that's really, it's like a little, if you have a lot of time and you're really, really passionate about something, obsessive, like I get sometimes, admittedly. I mean, it's an interesting concept because you can get really good at something in a short period of time, like really knowledgeable on something in a short period of time. You just need to have a process and a framework, and then stick to it. Right. Then that could take 3-ish months to do that, but it's better than going to school for however many years, and it's better than diving into real estate and then losing a bunch of money right away. Let's take 3 months, get really, really adept at something, and then And having a podcast, like doing podcasts, is a great way to do it. Like I'm learning from you right now.
Right.
Yeah. Like that's a great way to do it.
Yeah, and that's selfishly, so with my podcast that I'm going to start, it is really the main purpose of the podcast is going to be to bring experts on in their field to explain to people about these different ways to build wealth, enough that the person can decide, is that an avenue I want to pursue more? Do I want to spend the 30-30-30? Do I want to do that on that particular type of way of building wealth? I want them to hopefully try to get that from that expert in that interview, and then they could reach out to that expert and maybe learn some more or have some opportunities there. But outside of the education piece, like you said, I'm going to get to learn some stuff too, because I think there's too many people out there that try to be experts on, they'll say, and I was a stockbroker for 10 years. So somebody might on the surface say, well, then shoot, he knows a lot about stocks and, what might be good to invest in now. And I have no clue. It was so long ago and things changed so quickly. When I got my license, stocks were trading in fractions. They weren't trading in decimals. So it's been so long that I know, I recognize where my gaps are, and I'm not going to, try to educate somebody too much on that field, because so much has changed. So
we need to almost change the definition of what an intelligent human is, or a smart human is. It's not somebody who thinks they know everything or seems like they know everything. It's somebody who asked all the right questions and knows what they don't know.
Right.
Because they have more potential at that point now, right?
Right. And that are willing to be the dumbest one in the room, right?
Put their ego aside and just be dumb. I'm good at that. I'm good at that part.
Just surround yourself with. If you're the dumbest one in the room, you're going to learn something, right? I mean, you're in
the right room.
It's just like if you want to be a millionaire, you gotta surround yourself with millionaires, right? It's just the way it goes. So.
No, absolutely, 100%. So you're a product of your surroundings. It's hard to. The thing is that we go back to like having imposter syndrome. A lot of people will say to themselves or to others worse off themselves, I don't deserve to be in that room. It's like, well, maybe you don't right now, but if you're in the room for long enough, and you will, right? I mean, it'll happen, right? So there's where you get so much different information. And I was Googling this last night because I was getting ready for our conversation of where are we at as far as this bubble. This real estate bubble, and I would search 6 different websites, and like Wall Street, Forbes, like legit sources. Depends on who you talk to, and I would get 6 different answers. Like some would say, "It's 2024 is the year. Everything's going to crash. Everybody get ready." And then another one will be like, "It's going to be more of a soft landing," and then another one will say, "No, we're just fine." Right, like the average income is this high now. The only thing is that with interest rates as high as they are and home value is going down, it's less likely that people are going to move because they're locked into lower interest rates from a few years ago, and a lot of people are priced out of buying a new home. That's like that was the most consistent thing. But in your expert opinion, is 2024 the year? Like, are we going to crash? Like, what's going on?
That's the thing. And I'll give my opinion, but the reality of it is, right, none of us really know for sure. And so the one word I would say to sum it up is diversification. Don't put all your eggs in one basket. Because you have to recognize that, you can place some bets, and, you can over leverage yourself one way or another if you want, if you feel really strongly about something. But I think it's super important to be diversified and track your diversification and see how you're kind of keep an eye out on, are you getting too heavily weighted in stocks or real estate or whatever? Because unlike a lot of my peers, and I probably sound like I'm bashing a lot of real estate investors. I'm not, but there's a lot that will get up and talk and say that the stock market's horrible. Don't invest in the stock market. Only invest in real estate. Specifically, only invest in this kind of real estate. And that's great. That's great if that's what they believe. I don't believe in that. I don't think that you should put all of your money in one thing. And even if you're into real estate, I think it would be good to be diversified in different kinds of real estate as well. And even within that specific kind of real estate, like multifamily, you have to think about geographically too, diversifying and, not investing all of your money with the same sponsorship team that's running deals. And that's why with my fund that I started, it's all in Texas, right? But it's geographically diversified in different larger markets within Texas. And so somebody that invests in my fund, they're diversified across different markets within the state with different sponsorship teams that are running the deal. I'm doing value add, meaning existing apartment complexes that need to be updated, that you can increase the value that way, and development where it's being ground up development, right? So you have diversification that way in my fund as well. So I would just say, just be diversified, because the reality of it is, like, I don't care who the expert is. Nobody knows for sure. In my opinion, from a housing standpoint, whether it's multifamily or single family, there's been a lot of building going on over the last year or so. And in multifamily specifically, there was a lot of development and a lot of supply coming onto the market. And I'm going to oversimplify it because it really depends geographically in the different areas. But for the most part, in a lot of the bigger markets, there's been a lot of supply coming in, which has forced rents down a little bit, or kind of leveled out a little bit, which of course would then decrease the value of those investments. And so a lot of that development was started when rates were lower. And so now a lot of that new development has slowed down because rates have gotten so high. The numbers don't make sense for the development of new apartment complexes for the most part in a lot of areas. And so that has slowed down. And so now, you mentioned this year going into 2025 is when you can expect to see a lot more of that lack of supply and more demand. I think some of it is leveled out a little bit because of that supply that's hit the market, but you're going to see some of that supply reduced, and there's still going to be that demand. And that's one of the reasons why, for one, I'm born and raised in Texas, so that's why I stick with Texas. But there's a lot of migration to Texas and from a lot of different areas. And so it's a really great market. I think it's the 8th largest from a GDP standpoint in the world. So even, in the world, that just the state of Texas. So it's a really good market. But the problem with single family houses is rates have been were so low for so long that now nobody wants to sell their house because they're going to get less of a house if they go and buy something at these higher rates. And so I would think, until rates start getting lower, you're not going to see as many people selling. And so there won't be as much supply in the single family space. And so that's going to continue to be an issue from a supply demand standpoint. And again, there have been more developments of single family houses over the last year or so because of that, the lower the lower rates. But that has slowed down some too, again, because the rates are going up. And so I don't know that it's necessarily a bubble per se. I think we may see a little bit of dip in some prices here and there. Again, it really is going to be geographically specific, in terms of what that might look like. But I don't foresee anything like 2008 or anything like that. Things just seem too strong. Again, I could be wrong, but the economy is still going so strong. Unemployment is so low. And more than likely, the Fed's going to start lowering rates at some point this year, probably. I know they want to see inflation down, a little bit lower and a little more consistently down for a longer period of time. But yeah, I don't see a bubble necessarily. Again, in the residential space per se, which encompasses single family, multifamily, I don't necessarily see a bubble there. It's definitely gotten a lot more unaffordable for people.
Mm-hmm.
But income has also gone up
Mm-hmm.
substantially for a lot of people as well. I'm sure there's people that are going to hear this and be like, not me, and that's true. But overall, it has gone up, and that's going to probably continue for a little bit, because there's a supply demand problem going on there as well,
Mm-hmm.
in the employment space, with so many jobs being added. And so yeah, I don't see a bubble necessarily, but that's just Brian's opinion, so we'll
No,
see.
I mean, it's. I think I hope your opinion comes true. I hope that's the fact. Would you? So the opinion of, well, it's not really. It's an opinion. It's fact that average household incomes are going up. But how much of that do you feel is contributed to just the raising in the minimum wages in a lot of places?
I don't honestly know the stats around the raising of the minimum wage. I think what's caused a lot of the rate the growth in salaries has really been again the supply thing.
Mm-hmm.
There was COVID, and COVID was such a weird thing because it really threw so much standard stuff that economists and stuff like that, people like that look at, that it's like so many things went out the window. We should have
Mm-hmm.
definitely been in a recession well before now, based on how much rates went up and everything. When you look historically at what
Yeah.
raising rates like that has done, and it was a historic rate that we rose them this time. So I think a lot of it has just been so much competition for employees that they had to stay competitive, and they had to increase. Plus inflation was so high, people needed to make more to be able to get by. And so I know a couple of years ago, when I was still in the corporate world, I mean, there were people just leaving left and right with less experience than me, going and getting
Mm-hmm.
jobs at other companies, getting more than I was getting paid. And I had been there for 20 plus years, and they'd only been doing it for a couple of years, and they're getting more leaving to go somewhere else. And
Mm-hmm.
so there was so much competition, and I think the remote environment too contributed to some of that competition as well. But yeah, I don't know about the minimum wage part. It probably
That makes
does
sense.
play a factor. Yeah.
Well, you made a good point though, because there was a fairly big mass exodus, and there's stats, and this stats just isn't since COVID. This has been for the last 10 or 15 years. That if you're at like a mid management job and you leave to go to another company, the average wage increase is, I think it's like 4 to 8%. So
Yeah.
it's people that are leaving, if they get stuck at it. I'm not going to say stuck, but they're in a job for a long period of time, and they're at a certain wage, or they're at a certain salary. A lot of times the only way they're going to get that extra 4% is to leave and go somewhere else, because now all of a sudden there's competition for their skills, so they're able to leverage that. So they have leverage. So that's a pretty, so that's actually a very good point. With that mass exodus, there was, with that 4 to 8% increase, generally that's average, right? I mean, it could be more or
Right.
less. um, that would make sense, that could be part of the cause of some of these increases in salary. And then also these businesses having to, like, everybody working from home, then we have to bring everybody back. It's like, well, in order to come back, I want another 10K a year on my salary, right? And then they give into it, right?
Yeah.
So I mean, there's a lot of
Yeah.
that going on. So those are really great, really, really great points, Brian. So I wanted to kind of go back to it before I lose the thought. You talked about to diversify. So diversify your portfolio. So does that strategy of diversifying your portfolio, is that more to mitigate risk, or is that more to be able to pivot when needed quicker? Like where was that? Or is it a bit of both?
Probably a bit of both, but I would say more reducing risk. So I
Mm-hmm.
think that what a lot of people don't understand is that you can still get really good returns by diversifying. It's
Mm-hmm.
just they're risk adjusted returns, right? You're still getting good returns, but there has to be some value given to the risk that you're taking on when you're too heavily weighted in one thing. And I would be, I'd be lying if I didn't sit here and tell you that there's been times in my life when I've been way too heavily weighted in certain things. And so, I speak from experience where there was a time when I didn't believe in diversification. I'm like, well, why am I going to put anything in bonds or in cash or whatever,
Mm-hmm.
when this is doing so great? Why would I want to do that? Well, it's because, right, when it goes bad, you have to understand that now No, you don't just have to make up that 10%. You have to make up more than what you lost, because now you're starting from a lower a lower investment amount, right?
Mm-hmm.
So 10% on that amount that's lower now is not going to make up for that 10% you lost.
Mm-hmm.
So you have to think about that. There's some value in diversification to reduce that downside risk, and that's where I think a lot of people kind of miss the boat. And that's where, and the thing about it is too, I can't sit here and tell any particular person, well, if you're this age and you're at this point in your career, you should put this percentage in this and this. There are models out there that will do all of that. But again, it goes back to kind of early on in our conversation, we talked about, well, also what kind of risk are you willing to take, and how comfortable are you with risk? What is your risk appetite? Because if you're going to be, you shouldn't be in 90% stocks, even if you're 20 years old, if you're going to go and sell when they go down 20%. Now you just sold at the worst time to really help your growth going forward. And so, but I think the diversification piece is important, and I do think that real estate, in some shape or form, should be in everybody's portfolio. There's value in the real estate from a growth standpoint, but also from an income standpoint.
No, that's great advice, and from my kind of perspective on that, the reason I asked that question is in business in itself, there's this, you call it like negative inertia. So when you're so heavily invested in one avenue, one way of doing things, really, and if you have all this built up inertia and everything's built, if you built an infrastructure and just going in this direction, and there's a case study, Kodak is like a good example of this. Everybody remembers Kodak. They almost had a monopoly in the film industry. And then digital was coming, and they're like, "No, we invested so much in film. We're gonna double down and keep going." I think they invested, it's in the billions, I think, in more manufacturing plants, chemical plants, hiring people in film, and then digital came up, and where's Kodak now, sort of thing. So they had that kind of that negative inertia in the wrong direction. And the way I kind of, when you said that it's important to diversify, I was kind of thinking, if you're so heavily invested in one area, you have that negative inertia in that one area, and then you need to diversify at one point. It's harder to pivot. Is that the case in real estate, or in some cases?
It can be, depending on what you're in, right? So with some people will use REITs, right? So those are publicly traded, so you can easily liquidate those and rebalance and things like that. In the private space, it's a little bit more difficult in some ways, because, for example, my fund that I have is investing in multifamily syndications. And so that's 5 to 7 year hold period is what we expect. And so you can't, if somebody invests in my fund, they can't come to me and say, "Hey, Brian, I want to buy this house. I need to get some of my money out." Well, I mean, I can't just take money out of the deal. Like, that's got to come from somewhere. So it's not quite that simple. And so it really depends on the way you're investing in real estate. If you get some single family houses, maybe you could. Obviously, it's still not as quick to diversify, which can be good as well, because I think that it can take away some of the emotion, like I was talking about earlier, where, the market starts going bad and you're like, "Oh man," you start getting nervous and things start going down. And so you're like, we go log into your Schwab account, and you just push a button and you sell all the stock. Whereas in the house or multifamily, whatever, you can't do that, which can be good, because then you're not acting on emotion, which can get the better of any of us at some points, depending on what we have going on in our life. So, that I don't know if that helps answer your question, but that's kind of what I would say about that.
No, so there's ways that you can set yourself up, or set the way that you do these deals up to be more fluid and flexible if you want, but it's still not like going in and pressing a button. You still have to have a little bit more of a forecast before thinking ahead. You have to strategize ahead, forecast ahead, before making these decisions. Because it's not
look a little more long term. Yeah.
No, it's great.
One of the company that I thought of, though, when you said Radio Shack, was Blockbuster, and then Netflix, right? Like, Blockbuster never got on board. They were way late to the game on doing the whole, the CD thing that you get in the mail. They were way late on that. And so, but I think there's still one in the United States. I don't know where it is.
There's one. There's one. Yeah. Well, there's a lot. I mean, there's so many case studies of that, right?
Yeah.
And I think they call inertia by proxy, where they're just, this has worked forever. And this is just the way we do things, right? We don't, and it's working now, so why change things now, sort of thing. Well, I mean, it works till it doesn't. right? And then
Right,
and
exactly.
then it's hard, and then it's hard to pivot at that point, because now you're pivoting uphill to compete. Like if say even 10 years ago, if Blockbuster was to like just start pivoting, then maybe not 10 years ago. No, yeah, 10 years ago. This is when Netflix really started to gain like a lot of popularity. I think maybe even longer than that. Time flies. But if Blockbuster 10 years ago even said, okay, let's pivot and do it, they would have been so far behind. They
Right.
can't catch up, because Netflix created, or at least a big part of creating that market. And it's much
Yeah.
harder to identify a market that's already been created by your competition and then catch up. Right.
Right.
So you need to be able to be much more fluid than that. Right. So yeah, those are fun. Those are fun case studies to do.
Yeah.
But Brian, this has been an amazing conversation, my friend. I feel like I've learned a lot. I'd like to have a conversation off camera at some point.
Awesome,
But
for sure.
I always end these with one question, sometimes two. But for you, Brian, what is the next summit that you're chasing?
The next summit that I'm chasing. I think for me, it's and really for our family, where I want to be. The ultimate goal for me is to be investing my money with somebody else doing what I'm doing now, so that I can be 100% passive. I want to be able to. We want to be able to, as a family, go wherever we want and not have to be tied down to work and a job and we have some of that flexibility now with remote work and things like that, but to be able to be just 100% passively invested in other people doing what I'm doing now would be amazing. Time is the most valuable thing, that we can't get that back, and so that would probably be the summit that I would be chasing.
And what a great summit that is, my friend. Very clear on what you want. And that's obviously impacting the decisions that you're making in order to get it. So I really appreciate having you on, Brian. Take 30 seconds, even a minute, plug away your new podcast. I don't want to pigeonhole you, but when is that going to come out and everything? Where can everybody find you?
Yeah, so the podcast should be coming out hopefully in the next month or two. I'm hopefully going to be doing my first recording here in the next week or so. So that'll be coming out soon. Best place to find me is the only social media I'm on right now is LinkedIn. So you can find me on LinkedIn, or you can send me an email, brian@headstartequity.com. And of course, my website's Head Start Equity. I've got a little information out there about what I do and how it works investing in multifamily. But yeah, multifamily is 100% of my focus now. So if somebody's looking to diversify into real estate, multifamily is a great space to diversify into. People need a place to live, right? So, it's 100% passive, the investment that I offer. So, feel free to reach out to me. And if somebody, just like I mentioned earlier, if somebody wants to just learn a little bit more about it and they have some questions, I'm more than happy to help with that as well.
Beautiful. Brian, great. I was going to say Brian, great human being, but Brian, great human being. I'm really happy that I was able to have you on, my friend. I'm going to link all that stuff below. I'm not going to edit out any of my fumbles because it's real in here. But thanks so much, everybody, and we will see you in the next one. Brian.